So look, let's get things started then. So welcome along everybody today to our presentation, which is on the post 1 July indexation and a federal budget update. I would like to welcome to the presentation today, Jenna. Jenna, welcome along with me today.
Thanks so much for having me, Tim.
No worries. And the reason I wanted to bring Jenna into today's presentation is many of you would know Jenna through dealing with her as a senior client manager. And so I think it's a great opportunity to get somebody who is dealing with our clients on a day-to-day basis to be involved, because often with a presentation like this, I know that I will ask or I'll make a lot of comments that probably have a lot of you thinking about the ramifications of it. And so in many respects, when we were preparing for this, I was talking with Jenna about how we engage with each other, and it was like, well, what questions do you want me to ask? I said, well, there's no question that you can't ask. It's like, I know a lot of times in a presentation, people kind of a little bit hesitant to ask questions. So Jenna's going to try and ask some of those questions that maybe others don't, but also as part of the presentation, we do encourage people to ask questions as they go along. So thanks for helping me out today, Jenna. The disclaimer, I don't normally spend a lot of time talking about disclaimers, but as I'm talking about the federal budget today, obviously I will make a disclaimer that it's purely announcements at this point in time, and so we have to take a wait and see approach to what that means from the budget measures point of view over time. But also, I think importantly, because I'm talking about a number of contribution measures with reference to indexation, that often contributions and the capacity to contribute are linked to the ability to receive advice in that space. And so, I want to highlight that I'm not suggesting any strategies for any clients at all, that you do need to seek professional advice in regards to that space if you're unsure of the answers, but most certainly we can help out with the compliance and the rules around these sorts of matters. So that's what I intend to talk mainly to everybody about today. So what I want to focus on primarily is how the contribution caps and the transfer balance caps are indexed, because 1 July 2021 is a fairly critical date for the indexation of a number of issues. So I'm going to go through that indexation measure, and then we'll touch on the items that are impacted by indexation. So there's probably, largely with the caps, there are three key issues: our concessional contributions, our non-concessional, and the transfer balance cap. But how that impacts various measures, I think it's important to run through it. So we'll touch on some of those items in today's session. And then what we'll finish off with is a run through of the federal budget announcements. And, it was one of those budgets that I get asked questions all the time about whether or not I see or forecast anything significant happening in the budget. And you always clearly say, well, these are the things I'd like to see. And here are the things that I have no idea about. Well, this year, a couple of the like to see items got included, and we clearly got some leaks a couple of days before. So it was genuinely, not necessarily genuinely exciting, but genuinely happy to see a couple of the measures introduced. We'll be happier when we see the content behind some of those measures and what that actually means from a legislative point of view. So look, let's jump into it. As I said, please ask questions as you go along. Everybody after the presentation will be sent a link, so we'll send you a copy of the presentation to have a watch through afterwards if there's anything that you think that you've missed out. But also we'll send a copy of the slides through to all attendees today as well. So on the Zoom program, you have the Q&A. If you've got any questions, just click on the Q&A. You can remain anonymous. You can put your name. It doesn't matter how you wish to do that, and we will work through the questions as they come through. And as I said, if no one's willing to ask any, then Jenna,
I'll be here to ask.
That's right. Jenna's got plenty in reserve for me there, so we can work through it. So look, let's jump straight into it and start talking about indexation, because this has sort of been a key moment for superannuation since we had the legislative change from 1 July 2017. So, without going in and doing a history lesson, the superannuation world changed significantly in 2007, where we had the contribution caps introduced, and we'd started to get momentum on how those caps were being indexed. And then we had the super reform from 2017, which reset the contribution limits and introduced new indexation measures. So we effectively started again from 2017, and therefore we're in that holding pattern to wait and see when and how indexation would occur, and not just to do with contributions, but also in link to the transfer balance cap. So as we know, the contribution caps were introduced from 1 July 2017, but we were also introduced to this new concept, which was the general transfer balance cap, which was effectively the amount that limited how much we could transfer into a retirement phase pension, or if we were in retirement already in July 2000 or June 2017, how much we could retain in that pension, and then we'd have to transfer the rest back to accumulation. So the general transfer balance cap is largely our amount that fixes how much we can initially put in to the pension environment to get the exempt pension income deduction for our fund. So it's a number we watch with interest because it gives us that exemption for the fund on all the earnings associated with the pension, and it does get indexed, but we have to wait for changes in consumer price index to have it indexed in amounts by 100,000. So what that means is we actually need to see indexation increasing or CPI going up each year to get an accumulative sum or calculation done to make sure that when we multiply the $1.6 million by all these factors, that we get a sum greater than 100,000. So it took time. It took 4 years to get there. We were hopeful the year before, but didn't quite get there. But we got the indexation measure happening this year. Now, interestingly enough, because of COVID-19, there was a fleeting moment when it looked like CPI wouldn't get to the required level this year, because we had that real dip in the June quarter. And then we also had the Melbourne lockdown, and both those events really did take a significant hit on CPI. But then, of course, with the country reopening and childcare and people having to pay for it and other things, it created sort of an elevated CPI amount for the quarter that we needed it for, and that gave us the indexation. So we have our contribution caps, which are indexed in line with earnings, so average weekly ordinary times earnings, and the caps are indexed by $2,500 at a go. And then we have the general transfer balance cap, which is indexed in accordance with consumer price index, and that is indexed in amounts of $100,000. So we were watching both of these numbers when they arrived to see what that actually meant from an impact point of view. And thankfully, we got to the position where we now have indexation occurring and we have some new caps in place. And so what's important to understand is what it actually means for our contribution limits, what it means for our pension, and what it means for some of the legislative opportunities around and eligibility around certain capacity to make contributions of the fund. So really the first part of today's presentation is working through those eligibility issues and identifying the things that we need to address. And so I've used a couple of practical examples because I think just sort of listening in and following the dots on the page make it a little bit more difficult. So by giving some examples, hopefully it clarifies some of those matters for you. So from 1 July 2021, our concessional contribution cap will be $27,500. So that's irrespective of age. If you have employer contributions or you make personal deductible contributions, then they are entitled to concessional tax treatment up to that $27,500 from next year. Our non-concessional contribution cap is measured as 4 times the concessional cap. So the $110,000, which represents the non-concessional amount, is 4 times $27,500. Okay, so we had the non-concessional amount increasing to $110,000 from the 1st of July 2021. And we'll talk a little bit about eligibility for that in a moment. We then have the bring forward non-concessional amounts. And this is where complexity really starts
Yeah.
to hit. And I know, Jenna, you get a lot of questions in regards to this from clients in this space, but the bring forward amount is effectively 3 times the non-concessional limit, but it's about what you can contribute over a 3-year period. And so that's also subject to your balances and other things associated with the superannuation fund. So we'll work through that, because when we hit 1 July, you know, we have to be mindful of what's gone before us, what's happened before, and what opportunities sit ahead of us as far as whether we can use the bring forward rules. So, you know, we want to try and make sure that everyone's really clear on that when we get to that point. And then, of course, the big one from a pension point of view is that the amount that we can use to commence a pension has increased from 1.6 million to $1.7 million. And that's a really important measure to understand for anybody that's a new entrant into pensions. So they're starting a pension for the first time, that they're entitled to start a pension for up to that $1.7 million. The complexity comes about for those that have started pensions prior to 1 July 2021, and they didn't use the full $1.6 million that was the previous limit, and what assessment is done on their behalf and what sort of space they have available to use for pensions in the future. So we're going to talk a little bit about the personal transfer balance cap, and whilst touching on the budget a little bit later, I think from an industry point of view, we wanted to see, albeit that we're only 4 years into the transfer balance cap, we actually wanted to see some simplicity around the personal transfer balance cap and the processes associated with it introduced as part of the government's budget measures. Unfortunately, we didn't get anything, so it's one of those areas that we just have to accept the rules as they currently are and try to ensure that we understand them. So hopefully I can help clarify some of those rules for you today. So they are our key numbers: 27.5, 110, 330, and 1.7 million. They're the main numbers that we have to work on. And then we have to identify what that means in relation to the various eligibility and transactions that our fund undertakes. And that's where we have to link all of these thresholds and all of these these limits with this concept of our total superannuation balance. And I think that one of the things that I've always highlighted with reference since 2017 is that the big song and dance back then was about the introduction of the transfer balance cap, but probably the biggest concept that was introduced on 1 July 2017 was that of total superannuation balance, because it's a measure that dictates our eligibility for a number of items. And so you'll see just from the list that I've got there, the total super balance is a reference to eligibility for making non-concessional contributions. It's the eligibility to use the catch-up concessional contribution, and I'll work through an example of that. But it also is eligibility to be entitled to receive government co-contributions, a $500 limit there, to make spouse contributions, which are subject to the 18% tax offset, and also things around work test exemptions and disregarded small fund assets, which I'll touch on in a moment, but also reporting requirements. So when we're talking about starting a pension, whether we have to report for you on an annual basis or on a quarterly basis is subject to your total superannuation balance. And so it's a really critical number, and it's one determined by how much you have in accumulation on the 30th of June, but also how much you've reported as a pension commencement in your fund previously, and then effectively an allowance for earnings in that pension. So they call it a modified transfer balance amount, which is effectively your pension balance at the 30th of June each year, which of course would have made it a lot simpler to just say how much have you got in the fund or in all of your super funds. That is your total super balance, but they always bring in some weird calculations to it. But understanding the total super balance is important because it gives you access to a lot of these issues. And so if I start with the non-concessional contributions, the capacity to make a non-concessional contribution is subject to you having a total super balance less than $1.7 million. So if you've got more than 1.7 in total super across potentially across any defined benefit fund you might have as a government employee, your self-managed super fund, any sort of retail or industry fund that you're engaged with. If you've got more than $1.7 million, then your ability to make non-concessional contributions is effectively, it disappears. You've got a cap of 0. Now, that is an issue that we need to be mindful of, because the law doesn't prohibit you from making non-concessional contributions. It just limits how much you can put in entitled to a tax concession. So if you've got more than $1.7 million and you make a contribution to your fund, then that's going to be an excess contribution. Now, anyone that's unfortunately been through the excess non-concessional contribution regime knows that it's a fairly long-winded process to get those excess contributions back from the tax office, because you have to go through fund reporting, member reporting, and then the ATO requests the withdrawal of the excess from the super fund, and then the super fund sends the money to the tax office, and then the tax office sends it to the member. So understanding whether you should or shouldn't contribute is a pretty critical factor, because you don't want to go through the long drawn out process of having non-concessional amounts having to be returned. So 1.7 million is our limit there. Then our catch-up concessional contributions is 500,000, and that's an example that I'm going to run through in a moment as to how that works. Government co-contribution and the spouse contribution are both linked to that 1.7 million as well. And then the post-67 12-month work test exemption. This is a new measure that came in at the beginning of the 2019 year, which said if you've got less than $300,000 in your super fund, then the year after you cease working, you could make concessional and non-concessional contributions. So normally, once you turn 67, you have to satisfy a work test and identify that you've done 40 hours of gainful employment in a 30-day period before the contribution can be received. And you would know, if you've been in that position yourselves, that you then have to provide some evidence for the auditor to be satisfied that the contribution could be received. So that work test exemption still applies. And when I start to talk about the budget measures, you'll see one of the new budget announcements, how that is going to be linked to this work test exemption, because there is going to be, or there is an announcement about the work test being removed, but only for certain contributions. And so we have to understand and try and get our head around that in the future. So they're the issues that link back to our total superannuation balance. And that's why, I guess, Jenna, from an administrative point of view, you know, the ability to reconcile funds early in the year gives people a greater capacity to understand what their balance is from a contribution point of view.
Yeah, correct. And also, if you're ever unsure about making any of these types of contributions, always contact your client manager and they'll be able to run through all the requirements to ensure that you're eligible.
Yeah. So that's a key message, because you don't want to assume what your balance is and make contributions and get caught up in the excess contribution regime. Now, the disregarded small fund assets point is one that I wanted to highlight there, because that's the capacity to segregate assets. So if you have accumulation and pension members, you have the ability to segregate assets to a pension account, and therefore all of the income from those assets is exempt from tax. And basically what it means is it's all about actuarial certificates. So if you can segregate, you don't need an actuarial certificate. If you can't segregate because you've got more than that $1.6 million, then you need to get an actuarial certificate each year. Now, this is a quirk in the legislation, because the disregarded small fund asset rules were brought in at the same time as the general transfer balance cap, which makes an assumption that it should be $1.6 million and then go up to $1.7 million to marry up with the transfer balance cap, but it doesn't. It's actually fixed at $1.6 million. So it means that anybody with between 1.6 million and 1.7 million who starts a pension can't consider their fund to be segregated and would have to get an actuarial certificate. So it's a bit of an awkward quirk, and it's an area that we'll focus on and talk to trustees who are in that space themselves as to what the administrative ramifications actually are. But just be mindful that the rules are a little bit different there. So let's talk now about, let's sort of get into the nitty-gritty about the examples of how this impacts people and how the transactions are affected because of indexation. And so what I want to work on here is I'm going to go through an example of the carry forward catch-up concessional contributions in our $500,000 limit. I'm then going to talk a little bit about concessional contributions and reserves. So that might be a foreign concept to a lot of people, and it's not necessarily something that we like to encourage from an administrative point of view, but I think it's an area that people need to understand how the rules work, because it's a process that requires communication with the tax office, and an understanding of the timing for these sorts of events. And so it's important that in this year, when we have an indexation amount, people understand how those reserves work. Bring forward contribution rules will certainly work on that, and then we'll finish off with the pension commencements and the indexation of the personal transfer balance cap and what indexation means in that regard. So let's start by looking at the carry forward catch-up concessional contributions. So in a general sense, we have our financial years and the caps that are associated with those years. So as we see down the bottom line there, our 18-19 year, which was the first year that the catch-up concessional amount was introduced, 18-19 year all the way through to the 23-24 year. And there's a reason I put 23-24 there, and that is that the carry forward catch-up rules allow you to carry forward any unused concessional contributions for up to a 5-year period. And then after that 5-year period, those amounts drop away or they fall off. So it's effectively in any year you will use the concessional contribution cap for that year first, and then any unused amount from the previous year you can take into and use as well. So your cap in effect will increase each year if you haven't utilized the full previous year. So let's go through and work through the example to show you what that actually means and how it actually operates. So in the 18-19 year, if somebody makes a contribution of $10,000, it means that they've got an amount of $15,000 that they can carry forward. So first year one's always the easiest one to work out, which would then in effect mean that in the next year they could make a contribution up to $40,000, right? But if they only made $15,000, well, they've got the 15 from the first year plus the 10 of that year, which means they've got 25,000 in addition to the normal cap that they would be able to utilize. So again, all this information is tracked in theory, and I say in theory, but it's tracked by the tax office as well. So once your information is reported to the tax office, then what caps or what contributions you've used will be recorded internally so that they can measure, because the ATO are ultimately responsible for determining if you exceed your cap or not. So once they get a report from all of your super funds, then they will sort of merge that information together and determine how much carry forward amount you have. And so if we work through the example, see the next year we use the full cap of that year, so we're still carrying forward the original 25. The next year where we have indexation, which is next year, for example, we're 7,500 short, so we're carrying forward 32.5. Year after that, we use the full limit. So we've still got that 32.5. So then it's the next year when we make a $25,000 contribution, we want to look at what our carry forward amount is. The first thing that we need to understand is that year from 18-19 drops off at that situation. So all we're doing, being the 5-year period for what we carry into the new year, is we drop off that first one, which means that we've got 20,000, which is effectively our 32.5 less the 15 takes us to 17.5. And then if we can see that the cap there is 27.5 and we use 25, it means we've got 20,000 available. And then the importance is, how much have we got available to us in the next year to make a contribution? So what's the key number that we're looking for that year? Well, importantly, because this is all then measured against our total super balance, importantly, we have to look at our total super balance as at the 30th of June 2024, right? And if we're less than $500,000, then we can carry forward that 20,000 that is accumulated over that 5-year period, plus the current year's amount, giving us cap space of $47,500. So at any point in time in that cycle, if you want to use more than the current year cap, It's just a matter of ensuring that at the 30 June immediately prior, that your total super balance is less than $500,000, and then knowing what is available to you. So the carry forward concessional catch up is really beneficial if you have a significant tax event that you know is coming up. So somebody might be selling an investment property or something in a future year. Then they can look back if they've got a small or a self-managed super fund balance less than $500,000 or total super balance less than 500,000. Then that event, they might be able to make a larger contribution to get a higher tax deduction. Yeah, and so you still have to go through the process of your personal deductible contributions and your notice of intention to claim a deduction and all those issues, but it just gives you that greater capacity. And you know, one of the questions that I get asked a lot is, well, is that really applicable to self-managed super fund? Because self-managed super funds all have significantly higher balances. Well, the statistics that we see from the tax office don't necessarily agree with that, and you'll find that the median self-managed super fund balance, which is the person that's sitting right in the very middle of all self-managed superannuation funds, the median balance is about $416,000. So that means there's at least 500,000 SMSF members out there with less than 400,000, and then another good proportion between that 416 and $500,000. So yes, there's a significant proportion of the SMSF population that won't be able to satisfy the carry forward catch-up concessional contribution rules, but a lot of people will. And so the capacity or the use of indexation is beneficial because it adds, in this instance, that additional $2,500 to what we can contribute. And if we're looking at planning ahead, we can see what that actually means for the fund. So, you know, a pretty reasonable measure for us to look at. As I said, I wanted to touch on this concept of contribution reserving, and it's an area of, I guess, questionable use, but I don't mean to say that in a negative sort of way. It's more questionable because people really need to understand how it works in the SMSF space to appreciate the value of it. And the concessional catch-up that we just went through was really an opportunity to look ahead and see what opportunities might apply in the future year, and then look back over the past few years to see what we haven't used to be able to maximize our contributions. Where contribution reserving is beneficial is if we have a significant tax event in the current year and we have potentially no capacity to contribute in future years, then we can look at effectively almost bringing forward a contribution from that future year. But what we have to understand is that what the law provides us with is the opportunity for, or the requirement that contributions have to be allocated within 28 days following the end of the month in which they're received. Right?
So Tim, does that mean it can be contributed in any month throughout the financial year?
Yeah, so what that means, and that's a really good question, because the way that I present this when I'm presenting, whether I'm talking to advisors or accountants or trustees, is to highlight that this concept and that specific concept about 28 days means that from the 1st of July through to basically the 31st of May, but I like to put the 1st of June as I had there. It means if you make a contribution between 1 July in a year and the end of May, then that contribution under law has to be allocated 28 days following the end of the month in which it's received. So if you make a contribution on the 31st of May into your superannuation fund, it must be allocated to the member by the 28th of June. So for 11 months of the year, this concept is irrelevant, right? Because the contribution must be allocated in the year or within that following month. But when we're talking about contributions that are made in June, what this is ultimately saying is that the law requires that contribution to be allocated by the 28th of July. And so it posed the question, well, what does that mean from the contribution caps point of view? And this is how this whole thing arose. And it's highlighted by the tax office, which is why I wanted to bring it to everyone's attention today, because there's an actual process that trustees and members must go through. And that is that if you make a contribution in a specific year, then it is tax deductible in the year of receipt. Right? So if you contribute $25,000 this financial year, you're entitled to a personal deductible contribution of $25,000, subject to having the income to offset against. But if you make a contribution in June, for example, of $27,500, well, then you get that additional $27,500 deduction in that period of time. But because of the law, the amount doesn't get allocated until the following year. So to restate that a different way, it means that as a member of a superannuation fund, and ultimately it can apply to any superannuation fund, but I think you'll find that other funds outside of self-managed struggle with the process of what to do. But it means that you could contribute conceivably this financial year $52,500. And again, you might have a large CG capital gains tax event or something that's occurred that will have a tax liability. So if you can make that $27,500 contribution in June, then you can get the deduction for up to 52.5, but then the fund can allocate that $27,500 into the following financial year. Now, the caveat to that, or the catch is, you've then used all of next year's cap with that one transaction. And so that's why I said it might be one where somebody's entering retirement or some other event, because if you've got employer contributions going in, then you're going to be captured by those contributions next year, all being excess contributions. So it doesn't work very well to try and fix a situation where a contribution's made earlier than it should have been. It's really to identify a very specific set of circumstances, utilizing this year's and next year's cap to get a one-off tax deduction, and then allocating the second contribution into the new financial year, knowing that there'll be no further contribution made. So the reason I wanted to highlight it today was that this is publicised on the tax office's website. The process is publicised on the tax office website, but I wanted to highlight that if somebody was contemplating it and using the $27,500, that it wasn't two lots of 25 they'd get this year because of this year's cap. It would be this year's cap plus the second contribution up to next year's cap, and then allocating that 27,500. Now, the process part is, when you do this, the tax office will think you have an excess contribution, because they'll look at this year and see that you've made 52,500 or whatever the number might be up to that point. You then have to actually apply to the ATO and have that amount allocated to the next financial year. So there's actually a form on the tax office website to identify and work through this process. So it is a complex space, and it's one really only to be used in isolation of specific events, but it needed to be explained because the indexation does impact the capacity to do it. The critical thing is the contribution that you want allocated to next year must be made in June, cannot be made before. So if somebody contributed $50,000 on the 31st of May, then they'll have 50,000 counted towards this year's cap, and they'll have an excess concessional contribution, which will then go through and be taxed at their marginal tax rate. So, as I said, one of the things to be mindful of. So that just reiterates that point. The contribution is deductible in the year of receipt and assessable against the cap in the year that we actually make the allocation. Non-concessional contributions is probably the more significant area with reference to the caps and the indexation and complications and problems for superannuation trustees and the capacity to make the contributions. And so we need to understand what indexation means from a bring forward point of view. And I'll work through an example in a moment, but basically what it means is that from 1 July 2021, get my numbers right there, the non-concessional limit is $110,000. Means the 3-year bring forward amount is $330,000. But that's if you've got a clean slate. And the way it's calculated is if you've got more than 1.7 million, then your non-concessional cap is nil. Right? If you've got between 1.59 million and less than 1.7, as at 30 June this year, then your non-concessional cap is $110,000. If you've got between 1.48 and 1.59, then your cap in the first year is $220,000, and that cap is then locked in for a 2-year period. Now, when I say it's locked in, you lock in your bring forward amount if in year one you contribute more than the 1 year amount. So if your 1 year amount for everybody is 110,000, if you contribute $111,000, then you lock in either $220,000 as your cap over a 2 year period if your balance is between 1.48 and 1.59, or if your balance is less than $1.48 million, which is also going to be a significant portion of SMSF members, then your cap in the first year is $330,000, and that's what you lock in for the 3 year period. Now that's pretty critical at any time of year, but it's even more important to understand in an indexation year for a number of reasons.
So Tim, can I just step in and
Yeah.
ask what happens if you triggered the bring forward arrangement in the 2020 financial year?
Yeah, so that's a really good question, and I'll work through an actual worked example in a moment of that. But if you trigger the bring forward in the year, the 2020 year, or even now the 2021 year, then you are locking yourself into that amount. And so right now, the bring forward, maximum bring forward is $300,000 because the current non-concessional cap is $100,000. So the maximum bring forward would be $300,000. So once you trigger, then you trigger either a 2 year bring forward period as per this table here, or a 3 year, and that's always going to be subject to your balance the year before. So it's really complex. Like the understanding the bring forward amount is really complex and can create issues, particularly if you don't fully maximize it in your first year. So what's really easy, if someone in the 2020-21 year made a contribution of $300,000 because their non-concessional, or because their total super balance was less than $1.3 million, which was the limit previously, then they've used it for 3 years and they can't make a non-concessional contribution again in the following 2 financial years. That's easy. People might still make mistakes and then we have to deal with that scenario, but at least if we understand that if you use the full amount in year one, you've got no further entitlement. But, and to I guess highlight your point, is when the cap gets indexed, they don't get that little $30,000 increased amount until they've expired their bring forward period, right? And so we'll, hopefully maybe the example that I go through, these 2 examples will help explain that a little bit further. But yeah, it's one of those areas where, you know, triggering can be great if you can utilize it and maximize it, but you may not get the maximum benefit of indexation, or at least you may not get it immediately. Given the way indexation works, you might still get the benefit of being able to utilize it in a future year, but you may have to wait a little bit more time to do it. So when we look at the bring forward amounts, what we have to look at is how much can be contributed, but we will actually have to identify how far can we go back. So if we look at this situation here, and this is a little bit like the question that Jenna asked, but not quite. We'll go on to another example in a moment. In this situation, the client contributed $150,000 in the 19-20 financial year. So we would look at that and go, okay, well, you triggered then, which means that they've nearly utilized all their cap. But if we go back 5 years, and I always tell people you need to go back a 5-year cycle. Well, in the 16-17 year, we only put in 100,000, so we were under the limit that applied back then. But in the 17-18 year, this same client contributed $150,000. So when we're looking at the capacity to utilize the bring forward amount, what we're actually identifying is that they triggered the bring forward back in the 17-18 year, which limited them to make a contribution of $300,000 over a 3-year period, which meant that 150,000 they made in 19-20 was the end of their cycle, which means that we're only looking at the next year where they made $100,000. They haven't triggered it then. So when indexation occurs on the 1st of July, we're actually entitled to the full $330,000, subject to $1.48 million total super balance, and subject to us being under age 65 on the 1st of July.
Yep.
Now that I'm going to talk about a little bit later, because we're waiting on some legislation for all of the 65 and 66-year-olds to increase the bring forward rules. But at the moment, it's all subject to you being under 65 on the 1st of July. But if we take a look at a different example, and this is a little bit closer to the scenario that Jenna raised in her question, if we go back to the first years, we've only made $100,000, then that 1920 contribution of 150 is actually our trigger point. And that actually means that in this year, even though we've got a total super balance of less than 1.7 million, which is our go back to point to see what we're limited to or what we can contribute, we can only contribute a further $50,000. So even though the new non-concessional limit is $110,000, right, it doesn't mean that we can utilize that or the $330,000 because we triggered in 1920. We are stuck with that 300,000 amount until the end of the 21-22 year. And so in this instance, the client would only be entitled to contribute $50,000 next year. And then from 2022 onwards, they would be able to utilize the new 330,000 subject to their age and subject to the total super balance. So being mindful of all of that is obviously critical for the client to understand. So look, the bring forward is a complex area. And it's one that people need to be mindful of, because if you make a mistake, it's it's not dire,
Yep.
but you have to pay tax on the earnings, and those earnings are calculated by the tax office, and you have to refund that excess through the ATO process. You need to be mindful of that there. So look, the personal transfer balance cap, I want to work through an example here, just so those that are in pension now and looking to potentially start up additional pensions, that they understand how the personal transfer balance cap works. Because as I said before, if you haven't started a pension, then you're entitled to a general transfer balance cap of $1.7 million after the 1st of July. If you have started a pension, then we have another issue to go by. Now, Jenna, have we got a question that's come through?
We certainly do. So I'll just start this one off.
Yep.
So for a client turning 65 in June 2021 with a $1 million total superannuation balance, wanting to target the $1.6 million cap.
Yep.
Currently, this year is the last year of the bring forward arrangement. The bill to increase to 67 is not yet passed, and the budget may be left to 74. Should the client do the 300,000 this year, or anticipate a change that would allow them to get closer to their 1.7 million target?
Okay, right. So let me break that question down. That's a really good question. Thank you, Richard. This is a really tough speculative scenario. So we do have, and I was going to raise this a little bit later, so I'll talk about it now because I've just done those slides. So the bring forward rules, as I said, only applies if you are 65 or not 65 on the 1st of July in a financial year. So in this example, the client turns 65 in June. So on the 1st of July next year, it means they'll be 65. Legislation was introduced quite some time ago now, which increases that age from 65 up to 67. So anyone that is 65 and 66 on the 1st of July, theoretically from the 1st of July 2020, would be able to utilize the bring forward rules. That law hasn't passed yet, and so we're still stuck with this. You must be 64 to be entitled to use the bring forward rules. So the question is really saying, okay, well, are we better off using the $300,000 bring forward rules now this year, because the client is absolutely eligible because they're under 64 on the 1st of July this year? Or do we take a punt and wait and hope that the new law gets introduced, or the current bill gets introduced before the 30th of June, or at some stage early in the new year, to allow that client to be 65 and still use the bring forward amount? Or are we waiting for the 2022 proposed budget changes, which are that there'll be no work test, and so therefore everyone will be entitled to the bring forward rules up until their 74th birthday? Look, it's a really difficult one to be able to give an answer to, because what I say when I'm presenting in this space from an advising point of view is that it's obviously always easier to deal in absolutes, and in absolute we know what the current laws are. right? So we know what the current opportunity provides for. And then you've got to look at what opportunity does a client miss out on by waiting one more year. Well, by contributing now, they might be under their limit by $30,000. So they might contribute 300 versus 330,000. And then if all the work test rules and that disappear, well, then they'll be able to use the cap in the future years without meeting a work test. If they choose not to do the contribution now and use the bring forward now, and then the law doesn't get passed because it gets abolished because of the future budget changes, then next year, because of their balance now, if they're no longer working, they've got up till 67, they can put in 110 and then 110 up to their 67th birthday. So they might not miss out on too much. So it's a real complex one, Richard, as to whether or not there is actually any huge loss from waiting, given that the work test is no longer applicable up until 67 anyhow. So if they contributed 100,000 this year, then next year they could contribute, when they are 65, they can contribute 110 without meeting the test, and the following year they can contribute 110. So in their circumstances, ultimately they've only missed out on $10,000. So in that situation, it's probably worth waiting. And then obviously what happens beyond 2022 is another thing to be mindful of. So that's probably off the top of my head where I would think or take that situation. So I hope I've covered off on that one for you there, Richard. So to look at the transfer balance cap, but great question, really good question, that one there. The way that the transfer balance cap proportions is basically you get the cap space left based on what you haven't used. So if we look at a quick example here, in 2017-18, a client starts a pension when the general transfer balance cap was 1.6 million. We start a pension for 1.2. Means we've used 75% of our transfer balance cap. Means our personal transfer balance cap is set in that year at 1.6 because it's the first trigger event, and our transfer balance account is 1.2 million. We have an unused cap space of 25%, 400,000 available. When indexation applies, effectively what we get is, because of that unused cap space of 25%, we get 25% of the indexation level. So we get 25% of $100,000, which means that our personal transfer balance cap is indexed to 1.625. That, in simple terms, is how our personal cap will be indexed, and how nobody after 1 July this year will have the same cap for the entirety of their lives. They'll move from an indexation point of view, which means if somebody started a pension with $1.6 million, then that will always be their cap. 1.6 will always be their cap, and they won't have any space to put more money into pension. But there's another little example to contemplate, and that is for those that start to take out lump sums and they take commutations from their pensions, and that is that the personal transfer balance cap is indexed based on our highest transfer balance account balance. So to give that same example, if we started the pension with $1.2 million, we've got a transfer balance account of 1.2, personal transfer balance cap of 1.6, unused cap of 25%. If we then at a later date take out a $400,000 partial commutation, so we take a lump sum out of our pension, then that amount is a debit to the transfer balance account, which means our transfer balance account has gone from $1.2 million down to $800,000, which means our available space is 50%. We've actually got another $800,000 that we can put back in there, but the unused amount doesn't change. So our highest point was still that we only had 25% available to us. So the complexity around indexation comes for clients that have taken money out of their pension as a commutation. It means when indexation occurs, it's not based on how much you have in your account at that point. It's what was the highest amount you ever had. And in this instance, the highest amount was that 1.2, which means that from an indexation point of view, we're indexing to 25,000, and that's going to be the limit that we actually see inside of our fund. So what that means is that we've got the capacity to have $825,000 because we've got a 1.625 cap, And if we start a pension for up to $825,000, then we've fully utilised the cap. So really, what that example highlights is that you've always got to measure against the starting amount you had in your pension, not what you've potentially taken out for a lump sum point of view. So just something to be mindful of in those situations. So look, I want to now work into the federal budget announcements. And as I said, you'll get a copy of the presentation to be able to work through those examples. But there's a few, I guess, key issues from the federal budget that affect superannuation generally, but also self-managed superannuation funds. And so I guess what I wanted to start with was the general announcements. So those announcements that impact everybody in theory. And what I want to highlight is that all of these proposals are effective from the 1st of July 2022. Right? Now, they're effective from 1 July 2022, subject to being introduced into law. And we've got a federal election between now and 2022. I think I said too many 20s, but we've got a federal election in that period of time. What is the opposition's appetite for some of these changes? We'll only understand that as the measures sort of get debated and legislation gets introduced. So we have to be mindful of that. But the first one, downsize of contributions eligibility moving from age 65 to age 60. So that is one of the key measures there. First home super saver scheme deposit, the amount we can withdraw increases from $30,000 to $50,000. The removal of the work test. So I'll run through these, and then I know Jen has got some questions that she wants to throw at me. So I'll identify these and then run through some questions. The removal of the work test between age 67 and 74. So that comes back to that question that we just had, and a capacity that once you've hit 67, moving forward beyond 2022, you won't have to satisfy the work test. Now I'm going to go through that in a moment because that's a fairly significant change if it comes in. And then probably the biggest impact for the superannuation industry, albeit probably less impactful for self-managed super, is the removal of the $450 casual worker rate, ultimately from a super guarantee point of view, meaning that employers will be paying super guarantee from $1. Now, Jenna, I know you had some questions that you'd been receiving from some clients and that in regards to some of these issues in a general sense. Did you want to throw them at me?
Yeah, certainly, Tim. So just starting with the downsizer contributions, I had a client the other day sell his main residence, but he didn't put the proceeds into superannuation within the 90-day period. So he was wondering if he's still eligible, if there's any way to go around it.
Yeah, so it's a good question, and it's relevant whether it's now or in the future when we're talking about a 60-year-old as well. The key issue there is that the legislation stipulates that the contribution must be made within 90 days of receipt of the proceeds, so on settlement. But there is effectively a breakout piece of the legislation that says, or a time permitted by the commissioner. So in that instance, no one should ever assume that you can make the contribution outside that 90-day period. But I have already seen examples of where people have applied to the commissioner for an extension of that time, and that extension's been granted and the downsizer contribution has been made. So it's certainly one of the key issues that people need to be mindful of, is that there are rules and we should apply the rules. But if we can't apply the rules, then we should seek advice from the ultimate figurehead, being the tax office in this situation.
Great. And also in regards to downsizer contributions, are they subject to these indexation that's just passed?
No. So this is the other thing with a lot of these sort of quirky contributions and opportunities, is they're not subject to indexation. So $300,000 is still the individual cap on downsizer that anybody can make, and so therefore in a couple situation, from the proceeds you can contribute up to 600, but of course to do that you've got to actually have proceeds greater than $300,000. So you can't just say, well, I've sold the house, I have $300,000 sitting outside of super already, I'm going to put that in. You actually have to have made at least $300,000 proceeds on the sale of the house to be able to make the contribution.
Wonderful. So in regards to the first home super saver scheme deposit,
Yep.
what's your take on actually using this scheme as opposed to saving the money individually in your personal bank account?
Yeah, look, again, it's an interesting one because I suspect in many respects this scheme was introduced largely as a measure to help the fact that many Australians are historically terrible savers. And so by putting it into the preserved environment of superannuation, it gives you a safety net that the money is sitting there and you don't have access to it, which of course is the flip side of the whole thing, is that you don't have access to it. And if you don't therefore go through the process of eventually buying a house or do anything else like that, then the money is preserved in super until you meet a condition of release. So it's a really interesting measure to get where it's at from a regulatory point of view and statistics and things like that. I haven't seen numbers for quite some time as to its use. The increase to $50,000 I think is an interesting one because you can still only allocate up to $15,000 of your contributions each year to first home super saver scheme, which would mean that now in the environment where it's a $30,000 amount, it means that you're saving for potentially 2 years minimum. Whereas with a $50,000 limit, to maximize the first home super saver, you're going to be needing to contribute over a 4-year period. So it does extend the period out. So I think it'll be interesting to see, again, with all these measures, where the detail sort of fits in. So I think, again, for a lot of them, it's going to be a bit of a wait and see approach to how the legislation actually comes in. And then I think the two specific self-managed super fund ones, and we'll touch on this one. I'll go in through this in a little bit detail in a moment. Changes to the SMSF residency test. This is actually quite a significant measure for self-managed super funds. So I'll finish up and summarise on this one in a moment. And then this legacy pension amnesty. So this is not going to impact that many self-managed superannuation funds, but there's probably a couple of thousands of these pensions still in existence in and around the industry. So market-linked pensions, lifetime pensions, and fixed-term pensions. And other than all the other measures were very adamant that they'd start from the 1st of July 2022, this one was kind of a little bit looser, and it said it will commence from 1 July following its royal assent. And it didn't have the sentence about which we expect to be in 2022. So that either means one of two things. Either they've got some legislation ready to go and we'll be able to do it from next year, or they think it might take even longer to get the legislation, and so they didn't want to preempt that would be 2022. But if that measure comes in, it will give us the opportunity to unwind some of these existing pensions. So we'll have a look at that in a moment. But I wanted to touch on the work test removal particularly, and then the SMSF residency as probably the two key measures from the budget, I think, that are going to impact more people. The work test removal is saying that anyone under the age of 75 will be able to make non-concessional contributions without satisfying their work test requirement. Now, it also went on to extend to say non-concessional and salary sacrifice contributions, which I felt was an interesting one, because salary sacrifice contributions are employer-based contributions, which of course link them to the work test and satisfying the requirements. So I felt that was a really sort of weird inclusion for the work test requirement, because of course by removing that work test it makes it relatively simple. But then they went so far as to say that it's not going to be eligible, you're not going to be eligible to make personal deductible contributions under the work test, under this sort of work test removal. So that became, to me, a really complex matter, because all contributions all personal contributions are non-concessional contributions until you put in a notice to claim a tax deduction at the end of the, or after, or following the end of the financial year. So to make the contribution, it will go in as a non-concessional, and then if you then make a notice of intention to claim a tax deduction, will that then create a problem for the fund, and the amount has to be returned? So we really have to wait and see what the legislation looks like there. But I think the concept of removing the work test from 1 July 2022 is a great one for the capacity for people to make personal contributions. So we'll just sort of have to see how that one progresses. Of course, the flip side is going back to the total super balance rules before. With anyone less than 300,000, they'll still be able to make personal deductible if they worked in the previous financial year after age 67. So, we'll have to wait and see how that measure pans out. But I think it's a fairly interesting measure to keep our eye on. And as I said before, the bring forward rules and how they currently work are going to play a fair bit to do with that. I'm conscious of time, and so I want to make sure that we finish off this last little piece about the residency test, because I think from a self-managed super fund point of view, this is a really big measure if it comes in from 1 July 2022, because if you fail this test right now, your fund is non-compliant and you have to pay 45% tax. It's kind of like there's a full stop after that. There's no discretion. And a lot of it is based on two tests, the active member test and the central management and control test. And ultimately, from an active member test point of view, if all the members are overseas and you contribute to the fund, then the fund is going to be made non-compliant. But if you've got one member in Australia and one member overseas, and the person who is contributing in Australia has greater than 50% of the assets, then you satisfy that test. But if the person overseas has more money, then you fail the test. So it's a really complex test. So from 1 July 2022, they're hoping or they're proposing to remove that test, which will mean people can contribute when they're overseas. That'll be an outstanding result if we get there from a compliance point of view. The second part of the test is the second test is a central management and control test, which means you physically have to be in Australia to make decisions of the fund. But there is a safe harbour rule that gives you up to 2 years to be outside of Australia on a temporary basis, and you can make the decisions while you're overseas. And for a long time, well, 2 years isn't really a significant period, because people might go overseas from an employment point of view. They're always going to come back, but the employment relationship might be for a 3-year period, 4-year period, etc. So the proposal is that from 1 July 2022, that we actually move to a 5-year safe harbour rule, right? Which again gives a greater capacity for people to be away and not have to act, not have to contemplate enduring powers of attorneys and other things like that. So if these two measures go through, then that'll have a huge impact on the ease of administration for self-managed super fund, and particularly the ease for those traveling overseas. And I know we get a lot of questions about these on an ongoing basis. Jenna, any questions on that?
Is there any difference if both those measures or one of those measures don't go through to the...
Yeah, so I think it's a bit of a wait and see approach, but I think probably if the active member test doesn't go through, then we just apply the same rules as we currently do, which is don't contribute to your self-managed super fund if you're away, because it's awkward to try and get that 50-50 balance bit right. Whereas if it's a central management and control test, then there's already measures in place with the safe harbour rules, which is if you know how long you're going away for in advance, then you can apply the temporary absent rule. Or if you know the purpose you're going away for and that you're returning on the completion of that purpose, say medical treatment or something else like that, then again, you can satisfy that temporary absence rule. So I think the safe harbour extension, again, if it doesn't go through, we've still got capacity to meet the requirements, albeit that you might have to act a little bit quicker in those regards. So I think there's a number of areas to contemplate there. And of course, with all these things, we will keep people in the loop with how the rules are changing. So if I summarise to bring everything to an end, clearly contribution and pension limits increase from the 1st of July, but not for everybody. So if you've used your full pension, if you've got more than 1.7 million, then you've got no more non-concession, or you've got no more capacity to put money into a pension. So you just need to understand those rules. There are legislative measures that haven't passed through Parliament yet, so we still have to watch these with interest. The bring forward one being the most critical one, and the question is, what a great question we had, because it highlights the issues that we need to be mindful of at the moment. But also, on a quirky nature, the 6-member self-managed superannuation fund still being debated. If it comes in, it will come into effect from the first day of the quarter following its introduction. So if it's not passed before June, but it's passed after July, then it would take effect from the 1st of October, 1st of January, 1st of April, etc. So it's one of those things to be mindful of. I think more critically, though, from the budget point of view, these announcements are only announcements. So they're not going to commence until at least the 1st of July 2022, if at all. So it's one of those areas to be mindful of, that we have to watch this space and not start making downsizer contributions put prior to our 65th birthday, not try and withdraw amounts from First Home Super Saver, or not satisfy the work test, all of those sort of key issues there. We have to take that wait and see approach. And legacy pensions, we have to wait for the legislation to find out when that might apply. So I'm not sure whether or not, Jenny, you've got any more sort of general questions that you've been getting from trustees before we summarise, or if anyone's got any questions that they want to shoot through the Q&A box. But as sort of I introduced and went through, there's a lot to contemplate. We did our federal budget update that we sent you all recently, and if not yet, it will be available. I think it is available on our website. We are sending out more regular trustee updates on a lot of the measures. We'll certainly be running another trustee presentation later in the year, normally around the mid-year economic review by the government. So hopefully we have seen a little bit of legislation around by that point in time. But Jenna, did you have any other questions that you wanted to generally ask on any of these issues?
Not so much, but I just wanted to mention though, if you do have any other questions after this webinar, always contact your client manager. We're more than happy to discuss your situation as well. We have most of the information here, and we can work through your question together.
Excellent. I really appreciate that, and obviously I appreciate the work that the client managers do with regards to the communication piece. So, look, thank you all very much for joining us today. As I said, a copy of the recording will be made available to you all. A copy of the presentation will be made available to you as well. So if you want to go away and contemplate any of the points that have been raised, then by all means do so, and then hit us up with your questions afterwards. So thanks for attending, and we look forward to catching up with you later in the year. Thanks, Jenna.
Thank you. Thanks, Tim.